So following the rules in the blueprint, in general, what we look to do with the married put is with that bullish outlook, buy the stock, buy a put option at least 150 days or more out in time, with a proper structure slightly in the money to keep risk to single digits. Now, the blueprint discusses 12 different income methods, adjustments we'll use as the stock moves up, as the stock moves down, or even if the stock stagnates in price. There's different income methods for different markets after you open the position. Jerry's direct question is, with the married put tool, does it also help to figure out the covered call to utilize as the stock moves up? And I think what Jerry's asking is that when I go into the married put search and I see some positions that match our default criteria, 95, 98% of the positions that Ernie and I post in the Fusion subscription at RadioActive Trading, so investors can track along as a learning tool to see how we do this in our personal accounts, will come directly from this list. Now, personally, I might make some subtle changes first, Jerry, but not related to the call. Based on my personal account size and my personal risk tolerance, scrolling down below the listed trades, the default criteria looking for a single-digit risk, but based on my risk tolerance, I might lower this down to 7.5 or 8%. And also based on my personal account size, I'm typically not looking to do this with stocks above $85 or above $90 per share. So I'm going to go into the fundamentals. We're going to drop this down to $85. This is going to change the list for me. And so I only have a few positions that I'm analyzing as new married puts. ExxonMobil, which I think Ernie's actually in right now, if I'm not mistaken. 1OK Inc., Tempur-Pedic, Lattice Semiconductors, and EOG Resources. Well, I haven't looked at any of these recently. Okay, and Jerry, you're in XOM now. I haven't looked at any of these recently. I'm going to go with OKE while we're here. All right, the stock's trading at 59.45. I'm going to go out to April, 195 days out, with a slightly in the money 65 put for 990. Now, a lot of that is intrinsic value. Oh, I'm sorry, 1030, my apologies. A lot of that is intrinsic value. So the true monetary risk or the time value is only 515 or 7.3% of what I'd invest in the position. Now, I'm going to go further into this when I pull up the search, and I'm going to take a look at the stock chart, the company information, news and profile. I'm going to maybe look at this particular company compared to other competitors. But one thing that we know is that if the stock does move up, and let's say it goes up to 62 or 63, the first income method number one that's discussed in the free white paper, the sketch at radioactivetrading.com, is just to sell a call, to create a collar position, maybe 20 days out in time, maybe 30 days out in time, looking to lower this at risk amount, the initial low risk we have on the married put, by maybe a third to half, following the rules that are discussed for that particular income method. And I think Jerry's question asks, does it also help to figure out the covered call? What he might be saying is that if you got into this position, you had a low risk because it had a lower volatility. Before you entered this position, would you consider taking a look at the option chain? This one potentially offers weeklies. And maybe looking out 21 days, 28 days out in time, and analyzing the premium that's at the money. Now, remember, the stock's at 59.45 right now. The 28-day call, 1 month out call for 1OK Inc. would be the 60 strike. It's got a terrible bid-ask spread. So looking at the prices here, let's just assume the bid price of around 160. What am I extrapolating here? I'm extrapolating that if the stock does as I expected for this strategy and moves up 3 to 6% or so within the next 15 to 20 days, would the 30-day out call at the money, assuming everything stays the same, bring me what I desired for that income method? In other words, would that bring me in a premium to lower my risk by 1/3 to a half? In this case, it just does, doesn't it? And we're making an assumption there, of course. But if in 10 to 15 days, the stock does move up to 62 or so, or 63, about 5%, that's a bold assumption, but if that matches my targets and the stock does move up, then maybe at that time, the November 65 would be at a call premium around the same at the money strike, maybe a little bit less, maybe 120, maybe 140, maybe 150. So it's going to be close to that 1/3 that I want. This one's not half, Jerry. Okay, this one's would be more about a third. The 160 or the 150 put me at about 440. It's not something I do on a regular basis, Jerry. Analyzing what that call premium is or would potentially be at the money if the stock did move up as I'd expect. But there are instances, for example, when I would do that. Sometimes when the market's weak, as we've seen in the past 12 to 15 days, really from the 20th on, but it started a couple days before the 20th, that straight decline that we've seen in the last few days. And then the Evergrande thing took over on September 20th. But when we're in a down market or we feel that we've bottomed, sometimes I like to go off of this list, that other 5%, Jerry, or 2% I mentioned of trades that I entered that aren't directly from the Married Put screen. And I will go back to touchstone stocks of my own personal liking, something that pays a dividend, pretty big in the market, not necessarily a Dow stock, maybe something like Kraft, Johnson & Johnson. One I'm in right now is Ally Financial, which does have a little bit more volatility and some premium. So why am I bringing this up in that fashion? I know these have extremely low implied volatility, these more bellwether stocks that I'm talking about. I know they have a lower premium for the call side. And of course, that's just one of the 11 income methods I could use. Well, if the stock moves up as I expected, there's really about 5 bullish income methods I could use, potentially 6. But you're really focused on maybe 3 or 4 of those 12 income methods are for bullish markets. But just taking, for example, J&J today, let's say that I got into Johnson & Johnson. This isn't a direct recommendation or suggestion. As I mentioned, it's probably outside of my price range unless I sold a couple other positions, Jerry. But let's go ahead and add the stock in, buy 100 shares. And as before, I'm probably going out to April. Stick with April. I'm going to go 2 or 3 strikes in the money. I might go to the 175. I'm going to try the 170 first in this case. All right. Oh, yeah, that's perfect. We should probably stick with the 160. That risk is almost a little bit too low. I should stick with the 165. I apologize. That's going to be a better risk. It's probably going to be 5 or 6%, but it's only going to be 5 points away. I want April. And I want the 165 at about 1220, 1250, it looks like. Anyway, there we go. 1230. Let's just call it 1240. Okay, in any case, buying shares of stock at 160.47. Buying the April 165 put for 1240. So we're going to have a risk of about $7 because $5 of that is intrinsic value. 453 is intrinsic. So we have 787 of true risk on this position. And that puts us at 4.6% risk. Now, if I assume the stock moves up to 165 or so, or close to it, and I want to make sure the at the money premium maybe 2 weeks out or maybe 3 weeks out is at least a third of that maximum risk. What I can do now is, again, make that assumption, Jerry, on extrapolation. Where are we now? Well, 2 weeks out to October 15th for Johnson & Johnson. The at the money, we'll just call it the 160 strike, is around 250. Slightly out of the money, we'll call that 140. Now, that's not quite a third to half my risk of 787. I'm going to need a little bit more premium. I'd probably have to go, in this case, with a lower volatility, which XOM sometimes has as well, but it's been a little bit more volatile recently with changes in oil prices, the oil shortages, and things of that nature. We'll go out 30 days, take a look. We don't even have a 162, but the 160 is at 355. We can assume on these prices that if we had a 162.5, it'd be around 220 or so, maybe 240, which would be pretty close to a third of that 787 at risk. So that would be okay too. Where you typically don't see an at the money premium that would be as high as you want. Now we're talking about if the stock moved up, what is our expectation that our new at the money 165 call, 14 days out, 25 days out, 30 days out, would give us that third to half of the premium we want for this particular income method. Many investors who come across the radioactive trading idea or interested in this idea will look at it and say, okay, it's great. You're opening a position with a 4.6% risk. I'm only out to April. Johnson & Johnson does pay a dividend, so that risk is going to be lessened by that dividend price. But we get a lot of questions say, if I'm looking at a high dividend paying stock, say 9, 10, 12%, and I buy a 1 year out married put position, won't I be bulletproof from the beginning, meaning have no risk? And that's the goal, is to use the income methods to cancel this risk, have a bulletproof position, and still have unlimited upside with no risk to the downside. That's where I am with Ally Financial right now in the Fusion subscription. We tested that with one of the REITs Ernie did several years ago. He tracked a married put in the Fusion portfolio where he bought the stock, bought a 1 year out leap put option, 1 or 2 strikes in the money. It was about a $18, $16 stock, and the risk was 12%. And the stock paid a 12.2% dividend. So the dividend is kind of priced into the protection. Now, on that type of stock, what do we know about the call premiums? I know that if the stock's trading at 16 and this stock offers a 12% dividend, and I go out 30 days, the 16 strike call premium is going to be 5 cents. If I go out 60 days, it might be 10 cents. If I go out 90 days, it might be 15, it might be 20 cents. The prices are lower because the market's not expecting much movement on that stock because the yield is from the dividend. It doesn't fluctuate in price that often, so there's very little volatility in those cases. So that's a situation where Ernie did hold it for a year as a test to share with others and essentially found that the return was break even. He had 1 or 2 opportunities to sell a call, but the premium was so small, under 20 cents, it didn't really affect the overall risk. He collected the dividend and he got out of the position after the last ex-dividend date. The stock was down to 13 and he was essentially at break even. Because it's very hard to do income methods, and unless you get the growth movement in the stock, you're not able to sell higher strikes and you're not able to adjust the put to lower the risk and take further advantage of the dividend that's still coming in. That's sort of the risk there. So in essence, Jerry, the answer to your question is in general, no. When I'm first opening a married put position, I don't necessarily pay attention to the call premium myself to make sure that if the stock moved up to my expectations, that the call premium, assuming implied volatility and assuming other things stayed the same, would give me a premium that could lower that risk by 1/3 to 1/2 following the rules in the blueprint. One of the reasons why is, let me take out my other restrictions I put in. And the 9.5% really didn't affect it that much, Jerry. The stock price did. Let's go back up to the $200 or $300 range that are there for the defaults. Although things can change and we can expect that, other questions that typically come in when we're talking about the search tool here for the married puts and our default criteria that we use on the default radioactive sorting by earnings per share growth, which would produce this same list here. An attendee to the webinars or an investor will ask, well, what delta do you use for the put? What delta do you use to find the best controlled risk? What implied volatility do you look for? No, we're just screening for max risk that matches our criteria. Limited strike range in the money, because there is such thing as too little of a risk. Keeping it a percentage in the money, it's even. Maybe looking for some open interest or volume. And then the basic stock criteria that we have, stock volatility of greater than 0.25, because we want some movement. We don't necessarily want a stock that just has a volatility of 0.15, 0.12. We want to see a little bit more movement to give us that little bit more oomph in the volatility and the implied volatility of the options. Looking for stocks in an uptrend, positive earnings growth, and looking at the combined list. So the answer is, I'm not screening by delta. But I know for a fact that my deltas are going to be in a very restricted range. Here's our delta column. Looks like my highest delta is 0.63 and the lowest delta is 0.46. Usually I expect this to be between 0.48 to 0.68. With the other criteria looking for the proper risk structure and looking for the types of stocks that we want for this strategy, That's typically what I see. Let's just call it 0.45 to 0.65 in the top 10, top 15 results. Occasionally there's an outlier. 0.46 might be considered the outlier. In this case, 0.63 might be considered the outlier here on ALKS, going up to the 37 strike. What about the implied volatility? Well, I'm not screening by implied volatility, but all of the options, the put options far out in time, fall within a specific range of IV, 0.27 to a high, I think I saw 0.5178. Sometimes that's as high as 0.6, usually 0.3 to 0.6, depending on market conditions. What does that generally mean? That generally means that even though these puts are further out in time and might have a lower volatility than the near term, I'm still looking at reasonable implied volatility for the call options and for the options on these particular underlying securities, where near term I'm still going to be around this 0.35, 0.4, maybe 0.5 range, where that premium should be enough to give me that 1/3 to 1/2 of the initial at risk of these positions. If the stock does move up that initial 3 to 5%, I'm expecting in the first 20 to 30 days in the position. Usually 15 to 25 days is what I look for, Jerry. So because of my confidence level with that and what I've seen come up in the search results for years and years of using these search results, I don't always check it all the time. It is a good idea to do that if you're concerned that the positions that you found on this search, or if you adjusted the criteria to meet your goals, look for something with maybe more technical indicators using MACD or Bollinger Bands, anything along those lines, Jerry, and you're worried that it's a more Dow 30 stock that doesn't seem to have a lot of volatility, you might want to check that to make sure that you're getting the premium you want. And how would we do that again? Just as I showed you. I'll take ExxonMobil. You said you're in ExxonMobil, so I'll use that if I got in today. Bought ExxonMobil at 60.93. Probably consider again the April 62.5 call. Midpoint around 670, so I'm looking at a risk of 528 per share, 7.8%. And what do? I'm going to go to the profit and loss chart as we saw before. Stock's right at 60.93. Let's go to that 15 to 20 days out in time. Let's go to October 22nd, Jerry, 21 days out in time. And yeah, 61 call is at 160 to 170. Let's call it 165. That would be the expectation of an at-the-money call if the stock did move up towards my put strike price, and I consider the 62.50 or the 63 to be at the money. I'd expect a premium of around 165, which pretty close to a third of this. That would be 480. Well, actually, no, it'd be 495. So it's pretty close to 1/3 of the risk, which is what I want. And if I went to 30 days, it would match that as well. Okay? We are making an assumption. What's the assumption? I'm making the assumption that the implied volatility would stay about the same if the stock moved up, that the premium I could expect for 22 to 30 days out would be enough. I could also just go to the option chain and use the Black-Scholes calculator to estimate what a 30-day out 62.5 call strike would be if the stock was trading, say, at 61.80 or at 62 with 30 days to expiration. All right, while we're here, Jerry's got another topic question. It's a similar topic, but going back to the search, Jerry says, we can search for any stock, correct? Absolutely. In any search on power options on the 23 different strategies we support, you can set up the criteria to open up the universe of options to more underlying securities or restrict it more based on what you're looking for in the underlying stock for the strategy that you're using. Our default criteria are using a set list that we've preferred to use and we test on a consistent basis. Maybe once every year, once every 18 months, I run this married put search criteria that you saw, that basic default for the option criteria against our preferred list that we have in the default screens. And I look at the top 5 stocks for a 3-month out expiration, a 6-month out expiration, and maybe an 8 or 9-month expiration. And we just see how the stocks performed. Let's say of the top 3 or top 4 of those 3 cycles, 10 out of 12 moved up 5% in the first 30 days, and 2 dropped. Well, I'm going to change the list. I'm going to use the same option criteria screen just against S&P 500 stocks. And we're going to see the same thing. How did they work? And they usually work out maybe 8 out of 13, or 8 out of 15, or 8 out of 12 moved up 3%. 4 dropped 5%. 1 dropped 10%. Then we'll look at NASDAQ 100. Then we'll use just technical criteria such as Bollinger Bands, MACD ranges, days above the 20-day moving average, and more, and we'll run that analysis. And every time we do, our default list outperforms those other stock lists as well. There's a recent one for Blueprint owners that's available in the Fusion members only webinar content. Trust the search results. And we've got another one coming out soon. But I take that list out and screen against no list. We've got 17 results from my initial search, Jerry. I take out no lists and run that screen. All right, now we've got 187. More came into the list. I could open that up further by taking out the stock price limit. I could tell the system, hey, I'm not going to worry about volatility high or low. I'll leave average stock volume in there. But I'm not going to worry about if the stock's trading in an uptrend. Just show me more. Yep, over 600 results. See, now I'm not saving time with my options research and analysis. Where I'm going with this, Jerry, is you can search for any stock. What I'd consider is if you take out that list that we had and go to no list to open it up, put in some reasonable fundamentals. Maybe look for a market cap, mid to large cap stocks, maybe greater than 2,000. Or if you wanted to look for small cap stocks, that's fine. You could do that as well. Maybe a good PE ratio of, say, 0 to 50, nothing too outside of the bounds. I'd leave the earnings per share growth in. And yeah, I want to see some volatility on my positions. I don't want to necessarily see lower price dividend stocks that only move maybe 1 or 2% per month, unless I do, because I think the market's at a bottom and I think those are going to recover fairly well and I get the dividend. And yes, I'd look for something that's in an uptrend. I might even look for something that has a positive MACD signal that's withstood some of the barrage we've seen, Jerry, in the past couple of weeks. And there we go. Still 52 results, but completely different list now. Some of the same ones in there. Dana Holding Company, I think, was in the original list that we had. Goodyear was not. I think Dicom I saw in there. But now you've got Marathon, Holly Frontier, Air Lease, Summit Materials. So there's some other ones in here that weren't in that original restricted list. Now I do have to do what I wanted to do before. I'm going to do that further research analysis. I'm going to look at company information, look at the stock chart, make sure it's going in a pattern that I want, do some other research analysis, and then also, Jerry, check that call premium to make sure that it does potentially, the new at the money strike, if the stock does move up as I expected, would have that listing of 1/3 of the premium there as well. Okay, and these concepts that we're talking about, the navigation and use of the search tool we're talking about, applies to any of the strategies. If I want to do bull put credit spreads, for example, I have the same type of criteria. I can choose to search against a specific stock list or not. I can choose to screen with MACD, Bollinger Bands, technical indicators, and much more. So all of the same technical, fundamental, and availability of the lists, and to create your own lists, it's the same setup that you see in all 23 plus strategies: stock price range, earnings per share growth, PE, market cap, navigate over the technicals, Bollinger Bands, simple moving average, MACD cross signals, RSI. You have the ability to do that to open up the market more based on what you want to save for the positions or shrink it down lower. And of course, Jerry, if you just have one specific stock in mind with any strategy that you've been interested in, but whether it's the married puts, whether it's the bull put credit, whether it's covered calls, just go into the search by symbol. I haven't seen Apache for a while, so I'll go APA. And I know I want to go, again, at least 150 days out in time. And there we go. So I have my APA at 2180, Apache, 22.5, 13% risk. Not good enough. 25, 9.1% risk. Still too high. This is the risk I want, but it's 26% in the money. What does that tell me? That tells me as a married put position that I would follow for the rules in the blueprint, this is out of bounds for me. I don't want to be that deep in the money because it's lowering my expectancy of profit. I do want the risk here, but it doesn't match all my criteria. So I might look for a different position in this case if APA doesn't match my needs.